Hi there, everyone. I am attorney Kelly Longtin, founder of Kelly Longtin Law, where we focus exclusively on estate planning. So today I want to talk to you about gift giving and the benefits of it. Now, a benefit of working hard is sharing the fruits of our labors with our loved ones. Now, however, gift or estate tax consequences, they may impact a high net worth clients when they share their wealth. By crafting a comprehensive estate plan, you can address these concerns and protect high net worth clients and their loved ones. Now, I want to discuss 3 types of trusts that may assist high net worth clients in sharing their wealth in a tax advantageous way. The first is a grantor retained annuity trust. A grantor retained annuity trust, also called a GRAT, is an irrevocable trust that you can use to make large financial gifts to your loved ones while also minimizing gift tax liability. Now, these financial gifts remove future appreciation from your estate, reducing the amount that will be subject to estate tax at your death. However, there may be gift tax liability, which would be owed and paid at the trust creation. You can create a GRAT and then fund it with accounts and property, such as those that are expected to appreciate in value over the GRAT's term. Then you receive a fixed annuity payment based on the trust's original value for a specified time period. Once the period has terminated, the remainder of the trust accounts and property are transferred to your named beneficiary. Now, if you want to learn more about GRATs, there's definitely some more information out there that gets into just a little bit more of the specifics of this type of trust. Now, let's just talk about grantor retained unitrust. A grantor retained unitrust, or a GRAT, is an irrevocable trust that is kind of like a GRAT. Accounts and property are transferred to the trust, and you retain a right to receive an annuity for a fixed time period. Then at the trust termination, the trust's remaining accounts and property are given to your named beneficiary. However, with a GRAT, the annuity payment that you receive each year is calculated based upon a fixed percentage of the trust value that year. Therefore, since the trust value can vary from year to year, the annuity amount can vary even though the same percentage is used each year to calculate the annuity. Like a GRAT, the gift tax is due at the time the accounts and the property are transferred to the trust, and the gift tax liability is based on using the subtraction method. Because the annuity is based on the trust value that year, it is likely that the difference between what you give and retain will be zero, which will require that some gift tax will have to be paid. Now let's talk about Qualified Personal Residence Trust. A Qualified Personal Residence Trust, or QPERT, is an irrevocable trust that you can use to remove your residence from your overall estate. Now, ownership of the residence is transferred to the trust, and you retain the right to use and enjoy the property for a specified time period. Then, once that time period terminates, the residence is transferred to your named beneficiary. If you'd like to continue living in or using the residence, you'll have to pay the beneficiary rent. Now, you may need to consider your relationship with the beneficiary when evaluating whether this tool would serve your needs. Although this transfer reduces the amount subject to estate tax at your death, gift tax will still be owed when the property is transferred to the QPERT. The value of what is transferred to the trust, the amount subject to that gift tax, is the residence's value less the value of what you keep, because you have the right to continue using it. This estate planning tool's effectiveness depends on the federal interest rate when the trust is created. The higher the interest rate, the lower the gift value, and the lower the potential gift tax liability. You can establish a QPERT for no more than 2 residences. It can be funded using a principal residence or a vacation home or secondary residence, or a fractional interest in these types of residence. It's also important to note that if the residence currently has a mortgage, it may be advisable to pay off the mortgage before transferring ownership to the QPERT to avoid complications in administering the trust. Now, the important thing to note is with all 3 types of trusts is that you must survive them. When trying to determine the length of the trust, it is important to consider your current age and life expectancy. If you die before the trust terminates, the tax benefits will be undone, and the full value of the account or property will be counted towards your estate tax liability. Because each transaction is subject to taxation, It is important that you evaluate the gift tax, the estate tax, and the non-tax considerations before making a decision to use these types of trusts. I want to thank you for watching. I'm attorney Kelly Longtin, founder of Kelly Longtin Law, where we provide effective estate planning for everyday families.